You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate and multifamily expert, Ellie Perlman. Ellie is the founder of Blue Lake Capital, a multifamily real estate investment firm based in Southern California. Now, Ellie holds a master's in law and an MBA from MIT Sloan School of Management. She started her career as a commercial real estate lawyer, leading real estate transactions for Israel's largest real estate company. Later, she transitioned to a property manager role and oversaw properties worth north of $100 million. And so with that, I'm super excited to get onto the show with Ellie. But before we do, I just have a few quick housekeeping items. Like I do each and every week, I like to share my one personal best and one professional best. So starting with the personal best, my family came down with the flu last week. All week long, we were just knocked out and in bed, and it just really kicked our butts. That's the best way to put it. And I'm glad to say that we're all on the mend, and we're starting to feel like ourselves again. You can probably still hear my voice a little bit. So my personal best is actually feeling somewhat normal and getting back into a normal routine. Again, it really put us down for about the entire week, but we're back in the swing of things, and all is well. And now on to the one professional best. Just got back from a trip last week up to North Carolina where we viewed a number of properties that we're considering purchasing, and these are not mobile home parks. And we also just got an LOI accepted, so we're super pumped on that. And I'm purposely being mysterious about this as it's somewhat of a secret behind-the-scenes project that we've been working on for about the last year or so. And no, guys, it's not mobile home parks, and no, it's not multifamily. And so you're just going to have to stay tuned in the coming weeks and months, and maybe, just maybe, you'll be able to figure out what it is after I drop a few additional hints. Needless to say, we're super excited for this next upcoming opportunity. Moving on here, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, please be sure to leave a rating and review on iTunes. Also, subscribe if you haven't done so already. Lastly here, guys, before getting on to the show with Ellie, just want to remind you of the free 30-minute phone call that I offer each and every week. You can get on the phone with me and talk about anything and everything your heart desires regarding real estate investing. There's no ulterior motives here, just a way for me to connect and get to know you. One disclaimer, you must include some detailed notes of what you'd like to discuss during our call together. So when you make that appointment, be sure to put some detailed notes in there. Go to my website, kevinbupp.com, to get signed up for that call, and I'll look forward to connecting with you. And now, guys, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Ellie Perlman. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, multifamily expert and fellow podcaster, Ellie Perlman. Ellie, how you doing today?
I'm doing great, Kevin. How are you?
I'm doing great. I'm excited to have you back here. I know for those that might have missed the show, we had Ellie on the show back episode number 214. That was probably going on 6 months ago. And so bringing her back to talk about a lot of the exciting things regarding multifamily, but more specifically, instead of taking the 10,000-foot view, today we decided that we're going to take a more granular approach, and we're going to talk about one of Ellie's specialties, which is off-market deals. Now, there's very, very much a difference between on-market and off-market deals. A lot of folks have a misconception of what an off-market deal might mean. And so we're going to bring Ellie on here. We're going to talk about it. We're going to dissect it, pull it apart, and learn exactly how she has built her business, at least the last couple of transactions, more specifically on off-market transactions. And so, Ellie, with that, maybe we can start off by just a very brief background for those folks that just don't know about you. They haven't listened to episode 214. They haven't heard you on the other shows you've been on. Maybe give us a real brief snippet of your background and ultimately how you got into the real estate space, and then we'll dive into the topic of conversation today.
Sure, absolutely. So I was actually involved in real estate real estate has been a major part of my life for over a decade now. I was a real estate lawyer back in Israel, where I'm from. You can probably, tell that from my accent. And I was working on huge deals and understood I was on the wrong side of the table. I wanted to be my the customers that I was representing. And so after that, I worked as a property manager for about 4 years. And then basically went to MIT and got an MBA degree. And with all that knowledge and experience, I started Blue Lake Capital about 2.5 to 3 years ago. And what we do is very simple. We buy multifamily properties in Texas, Florida, and Georgia. We buy value add properties. We renovate the units. We improve, the amenities, the properties, and that's basically how we make money. And of course, we work with investors the same way that you do, and we own over 2,000 units, at this point.
Okay, fantastic. In addition to that, you're also passively invested. Other than the deals that you're actively involved in, you're also passively involved in a number of deals as well, correct?
Yes, that's right. So passively, I invest in, with other syndicators, mainly, one that we like to invest with in multifamily, but also office, other type of asset classes, just to diversify and make sure that, our money is not involved only in, one area or one market. So, and of course we invest in all of our deals as well.
Absolutely. It just, not to digress here, but are there any other, you mentioned other asset classes. What are the other ones of choice of you other than multifamily that you are passively invested in?
Sure. So office is one of them, even though I have to say that we're very careful when it comes to investing in office because of where we are in a cycle right now. So I think that, once there's going to be a correction, we're going to feel it more, when it comes to office space more than multifamily, because everyone has, to have a place to live. But when it comes to office, companies close, they downgrade, they move to other, offices, so smaller ones. So that's one type. Multifamily, of course, is one of them. And we're also looking into other types of commercial real estate. Cannabis real estate is one of is very close to my heart, because I think there's a lot of potential there. And so we invest in that as well.
Okay, fantastic. And I know the topic of discussion today, we're going to, again, take a little bit more of a granular approach, and we're going to talk about off-market deals. And so I just simply put, I'd love if you could, maybe in your space, the multifamily space, again, we're in multifamily, but we're in a different type of multifamily. We're in the manufactured housing side. And so I feel like every different niche kind of has its own definition of what really off-market means in that respective space. And so maybe speak to that. What is the definition of off-market deals in the multifamily space?
Absolutely. So when it comes to off market, it means that the deal is not marketed in the free market, which means basically, if you go to the internet, you go to Marcus and Millichap's websites, for instance, then you'll see all the offerings that they have today. This is a marketed deal because everyone can have access to, the information. And so that's a marketed deal. An off-market deal is basically a deal that either you as a syndicator or an investor, get that deal directly from the owner, or that it's a deal that the owner is working with a broker, but the broker decides to reach out to a handful of investors or syndicators and basically say, hey, I have this deal. I'm only going to introduce the deal to 3, maybe 5 different groups. The owner doesn't want to take it to market. And so that's kind of the definition of off-market deal. And usually what happens with us is that we're in that second type of off-market deals where we basically build relationships with brokers, and through that we get the off-market deals.
What would the reason be that a seller, given the competitive market landscape, it's very much a seller's market. And so what would be the reasonings behind a seller not wanting that broker to take it to the open market? In my mind, it would mean that it would probably drive the value much higher. You'd have a lot of additional competition, bidders bidding up the price, hopefully netting a higher profit for that seller. So what would be the reasons behind them potentially wanting to keep it off market and only really put it in front of maybe 3 to 5 sets of eyeballs?
Yeah, that's a good question, Kevin. So sometimes the owner just doesn't want to take the deal to market because, owners know that it takes time. It's a longer process if you bring it to market. So if they want to sell the property quickly because, maybe for personal reasons, they need the money right away. Maybe it's a partnership that is falling apart and everyone just wants to get out of it as soon as possible. They want to finish with the sale, with the deal within, 2 to 3 months. You can't really have that compressed timeline when you're taking the deal to market, because when the deal is a marketed deal, then it takes time for the broker to visit the property, to create the marketing package, then start the process and give everyone, several weeks, maybe a month to submit the offers, and then have a second round, which is the best and the kind of the best and final round, and then decide who to go with. That can take 6 months, 5 months, maybe even more. And so many times owners just want to sell, quickly. And that's the number one reason why anyone would sell, off market.
Okay. Would you mind giving a case study? I know you had mentioned before we started the call here that, you've had some recent deals that were truly off market, that weren't taken to the free marketplace for a variety of reasons. Maybe just pluck one from that batch and give us kind of the case study, the lay of the land of, maybe why that seller wasn't looking to take that property to market, what the bidding process looked like, what were some of the challenges with the property, what have you. Maybe just general case study of what that deal looked like from beginning to end.
Yeah, absolutely. So in one of our recent deals, it was basically a partnership, 3 partners, and basically 2 of them wanted out. They were not getting along, so they were forcing, the third party, the third partner, to sell the property. And so that's why they didn't want to sell it they wanted to sell it off market. They wanted to get out of the partnership and sell it as quickly as possible. And that was kind of the backstory. When we arrived at a property, we realized that the entire team basically quit. So for every big property, if it's 100, 200, 300 units, usually the owner is not managing the property. There's leasing officer and a maintenance guy and an entire team that their entire job is to be at the, in the property from 9 to 5, from, 8 to 6, whatever it is, to take care of the property. And because the relationship was so bad with that specific owner and operator, then at some point everyone quit, one day, and he was left without the ability to actually manage the property.
Wow.
So that's, those kind of things, they can happen, even if the property is marketed. But when it comes to, this deal was off market, the operator was experienced, but not enough to really handle the properties. And so that's what we call a management play, where, the properties are in good shape, they're in decent location, but we see a lot of opportunity to step in and improve the operations, just bring better people, take care of tenants. And so that's basically, one of the challenges was with an off-market deal, you don't have all the documents that normally you have to begin with, because with a marketed deal, you have a package, you have all the information, because brokers are trying to make it easier on you. So it took us a while to get all the information that we needed. But it was worth it, because we purchased the deals at over 6.5% cap rate at a 5 to 5.5 cap area. So right when we completed the sale, we already had equity built in to begin with from day one, because we were buying right.
Okay. Very interesting. You might not know the answer to the question, but the question immediately comes to mind with that the owner of that property. He had to step in, his entire team quit on him. Would it have been just as simple for him to essentially just, call up a local property management firm, which I'm assuming that you guys used a third-party management company, like you probably outsource your property management. So wouldn't it have been just as simple for someone like that just to pick up the phone, interview a few local property management companies, and have them step in and kind of take over the day-to-day?
Yeah, which he did actually. And, he believed that that would be the right thing to do. But you
Mm-hmm.
have to be very careful that, who you choose, and make sure that, it's a very sensitive period from the time that you're actually starting negotiating, because what happens, and that's kind of, I want to kind of, explain what's happening behind the scene. When you get a deal, basically you sign an agreement with the owner, and then you have about 60 days to complete the transaction. So in those 60 days, you need to finish your due diligence, and basically finish with all the financing, sign on the loan documents, and make sure the money will be there within the 60 days, time frame. Now, might sound like a lot of time, but it's actually not. And so what happened with that property is that the owner did exactly what you suggested. They called a property management company. They hired him right away. But the property management company decided to clean up the property, which means that they basically evicted a lot of tenants. Now, this is very unusual. Usually what we see, not in all properties, but usually what investors see, is that right before the sale, a lot of owners are packing their, they want to show high occupancy. So they bring tenants that shouldn't have been there to begin with because they don't qualify, based on income requirements. Here, the opposite happened. They decided to clean the property and to evict people that don't, have certain requirements. So that's another, I'm not saying that happened because it was an off-market deal, but that was an interesting, thing that we had to deal with.
So what was the occupancy at when you guys finally closed?
That was in the 80s. When we first saw the property, it was above 95%. So it dropped significantly.
Wow.
And now it's back, it's stabilized again. It's, above 90% now. But we found out about it, 2 days before closing. And it means that technically it shouldn't be qualified for a Fannie Mae loan, but we're able to convince the lender to keep the loan, because we were working with a great, with Northmark, which were, very, very solid lenders. But to go back to our topic about off-market deals, the fact that that was an off-market deal, there was a lot of equity there, and we bought it on the market, really helped us, deal with the issue with the lender, because we said, hey, this is exactly what we're talking about. This is why this deal is so good, because the management is not strong enough to really run the property the way it should be. So that's one of the main pros when it comes to off-market deals, that many times it's a management play. That's why it's being sold under market, off market. But on the other hand, because a lot of those sponsors or investors are not that sophisticated and experienced, then you have to deal with issues like the issue that we were dealing with the sudden decline in occupancy. So it's kind of a double-edged sword. The pro can be a con, but it depends on how you look at it, if you're willing to deal with it. And that's how we presented it to the lender, basically saying, see, this is what we're talking about. This is why we can make a lot of money here, because we're going to make sure the property is run the way it should be.
Was there any kind of price reduction, in the 11th hour when you guys found out about all those, additional vacancies?
Yeah, because basically you're buying a property that has less, with fewer tenants. So yeah, we had an adjustment, and we were lucky enough to have some sort of a mechanism in the agreement that if something changes, and that's a big tip for anyone who listens, who is thinking to buy multifamily or actively buying multifamily properties, or actually any type of properties, have a mechanism in the contract that if something changes from the time you sign on the agreement until the time you close, that there's going to be a mechanism that can take that into account and adjust the price or give you some credit. Because when you sign on the agreement, you have a certain NOI and certain occupancy, and that changes over, 30, 60, 90 days, you're not buying the same property.
Yeah.
And you have to, make sure that it's there, so it's easier to negotiate it.
Does that wording in your contracts, we don't use that in ours. And so the question is it's authentic from my side. I don't know the answer to it. Does that mechanism inside your purchase agreements, does it have a specific formula that states, based on this economic occupancy, if it changes by this amount, that equates to this amount of a discount or, credit, what have you? Is it specific to that nature?
Yeah, well, partially. So for instance, for every down unit, there's a certain amount of money that we get as a credit. Okay. So if you start with one down unit and now you find out after the due diligence that period that there are 3 down units, then that formula kicks in. We don't have anything, more granular than this for any other, scenario, because there's so many scenarios, we can find, other things that change. So it's pretty much open, to negotiation. But the main 2 things that we're looking at is occupancy and NOI, and how they change from the time you sign on the PSA, the purchase and sale agreement, until the time that you close the deal.
Got it. Other than a strict management play here, what are some of the other value add components of this deal? Have you guys had to, put a lot of money back into the CapEx as far as improvements are concerned? Is there a big rent bump coming at some point in time in the future?
Yeah, so surprisingly to us, the properties are in very good shape. So it was a management play, but the properties were not neglected. We put up a budget, and we were planning basically to renovate the units and raise rents by about $100 to $150. What we found when we took over was that we were able to raise rents by $80, $85 without renovating the units at all, because the rents were under market, which is again part of the management play. So the goal was, we started renovating the units and improving the curb appeal, and by that, the goal is to push rents, and we're already getting there by $100 to $150, $175 per unit. And we put between $3,500 to $5,000 for, the interior renovation, so we can make the units a little bit more, desirable, and to attract tenants that are willing and able to pay, higher rents. Got it.
And do you mind me asking what market this is in?
Yeah, that's in the Atlanta market.
Okay.
Deals.
Got it. And C+ class, B-, what category would you place it in?
So both properties are B properties. One is 1986 and the other one is 2004. And we bought that as a portfolio. So again, it's, it was off market, and it was a great opportunity. And basically the way that we approach it, when many people think, there's a misconception around, off-market deals, then, most people think that we reach out to the owners directly, but my approach is actually different, because if we're going to do that, we're going to be competing with brokers that their entire career is in building those relationships.
Sure.
And so what we do is we focus our attention and our resources to build relationships with brokers. So once they have something, then we're able to have access to those deals. In addition, from my experience, owners that are open to discuss directly with investors, they usually don't own the large properties that we want to buy, 100 to 300 units. It's usually, mom and pops, those who own 10, 20, 30, maybe 50, for the most part. Of course, there's exceptions to that. And I'm not saying that these are not good deals, but we tend to focus on the larger deals.
Sure.
And usually it's really hard to reach out to get to the actual owner. There are a lot of people, in between the direct owner and the property. So that's why we find it most, the smartest way to find off-market deals is basically to build relationships with brokers.
Got it. And what is the, for those that are getting started, or maybe they're making a shift from one asset class to another, what would you say is the most fast track approach to not just building that relationship, but one step before that, actually identifying, assuming that they've got a market that they think they want to invest in, but identifying who the key brokers are that they should be initiating those relationships with. A market like Atlanta, giving your example of this deal that you disclosed, it's a massive MSA. It's huge. I mean, I'm guessing that there's hundreds, if not thousands, of brokers that have participated in multifamily transactions. Some are probably specialists in that asset class. Others, are generalists. They do a little bit of everything, but they've closed some multifamily deals. But how do you really fast track to those brokers? The 3, the 5, however many it is, that are going to be the best suited for you and your business and your help you reach your ultimate goals?
Yeah, that's a really good question. And I actually have a mentoring program, and that's part of what I teach, my students. The best way to do it is basically go online. It really depends. If you're looking for, to purchase larger multifamily properties, then I suggest you go and check the biggest brokerage firms. So, Marcus and Millichap, CBRE, the Cushman and Wakefield. So go to their websites, and even if they're big, not all of them are strong in all markets. And you'll see by the number of deals that they have if they're strong or not. You can, there are other websites where you can register, and it will send you an update on all the deals in areas from all brokerage firms. So that's, I think they're called World Capital Markets, but I forget the exact name. So you can register there, sign up, and then you can get all the information. I would say that's one way of doing that. You can also reach out to other syndicators that that are active in that market and just ask them, who are the best brokers that you think I should be in touch with? Maybe even ask for for a referral that can really help you, help positioning you in a way that they're not going to see you as someone, as a newbie, but someone who actually has connections in the market and is serious about buying a property.
Yeah. What are some of the other things that brokers are going to look for, from a new investor, someone that they do not have a relationship with yet? Even if that introduction's made, they're going to be looking for the track, that individual's track record, right? They want to ensure that they've got the capital or the wherewithal or access to the capital to actually do a deal, to execute on it if something is brought their way, right? What are some of the other big things that a broker is going to be seeking? Because right now it's the tables have kind of shifted. The brokers don't really have to go out and try to find buyers. There's plenty of buyers coming to them, knocking down their door, and they've only got so much time today. And brokers really only get paid when a deal gets closed, right? When it makes it to the closing table. And so they want to make sure they're spending their time appropriately and efficiently, and only working with those that are true closers. And so being new, how do you position yourself as that guy? Like, I can truly get this deal done and get it to the closing table.
Yeah. So I can share from my own experience. When I started, so first of all, I did some research about, who the biggest, brokerage firms in a certain market. When it comes to, and then I did research. I looked at some deals. I ran the numbers. And then I reached out to them. I called them on the phone. I introduced myself, and I scheduled meetings and property tours with them. And then I just flew out there, and I walked the units with them. So they will have some, FaceTime with me that they can get to know me. So to your question, what they're looking for is surety of closing. That's the only thing that they care about. Because if you can't close, it damages their reputation. They wasted time, and they're not going to get paid. And they potentially lose the deal to another firm. So they're looking, what they're going to do when they're vetting you, the brokers will first of all go to your website. So if you make sure you have a website, and when you're reaching out to them, tell them about yourself and add the link to your website. And on the website, make sure you have you're listing all your deals, so they can vet and they can look into the deals that you put there. Some of them even, take the next step and look at, Yardi Matrix or all those other databases and see if your company is actually listed as the owner. And if not, they're going to ask you about it. So they want to make sure that you're able to close. They want to see that if you're looking to purchase a deal and you've done something in the same size previously, that you're not going to have any issue raising the money. They're going to ask you where the capital is coming from. Have you worked with those people before? And basically they just want to make sure that you're able to execute and do it quickly, that you're easy to work with. But a surety of closing is number one. That's king.
Yeah, absolutely. Yeah, they want a paycheck, right?
Yeah,
and protect that and protect the reputation, right? I wanted to ask you about this. You shared the case study of that the recent, I guess 2 community portfolio that you purchased in Atlanta. In a situation like that, or any situation, before you actually make a formal offer, are you or one of your team members actually flying and getting some boots on the ground, or does that happen after the fact?
Yeah. So the way that we work, because we sit in California, but we buy in Georgia, in Texas and Florida. First round, we submit an offer after our property management company is walking the property. We have a discussion with them, and we get, actual numbers on how much it's going to cost us to run the property. Then if we are elected to be part of the best and final round, which is the last round, then I personally fly out there, walk the property again with the property management company, tweak the numbers, talk about specific ideas on how to improve the property. So we're going to look into, things like, can we create pet yards and increase revenue that way? Are they, usually you get between $50 and $100 a month for that. Can we convert some of the parking spots to reserve parking spots, and maybe carports, or all kinds of ideas to increase the profitability? And then we submit the final offer. So there's always someone that is walking the units. We never send an offer, a blind offer. That's not happening. And I don't recommend anyone to do that, because what if you're selected to the best and final? Yeah. And then, you're not going to buy anything without seeing it. And then if that's the first time that you or someone on your behalf is walking the property, and all of a sudden it looks completely different. Many times I can tell you that we think that a deal is decent. And then when we fly out there, when we send the property management company, they get back to us and say, you don't want to buy this property. It's in a bad location, or it's in a very bad shape. The roof needs, you'll have to replace the roof. That's, $1 million, $2 million. And then we decide not to move forward. Or they say, hey, this is an amazing deal and you should try and get it, because we really believe in that deal and we see a lot of potential.
Have you actually had management companies truly steer you away from deals? Does that happen often? If they identify that it's a bad location. The reason why I asked the question is, down at the core of it, and I know there's really good property management companies out there, but the interests aren't as equally aligned being a property management company, right? Like they're paid on top line revenues, not on bottom line revenues. And so, their best interest is to have more clients, do more deals, have more top line revenue. As a syndicator, in your best interest is to have the highest bottom line revenue and gross profits for your investors. So I guess my business is very different than yours. So again, I don't know the answer to the question, but as far as multifamily property management companies, are there a lot of really good ones out there that will truly push you away from bad deals and steer you closer to the better deals?
Kevin, this is such a key point, because as you mentioned, their interest is to get more deals. And even if it's not the best deal for their client, they're still making money, because they're charging, 2.5-3% of the net income. The good property management companies that we work with are those who are smart enough to be honest and say, this is a bad deal. Yes, we want your business. We want to manage more properties, but I would not buy this property. And part of the reason why we involve them in the process is because once we underwrite a deal and we submit an offer, we are relying also on the numbers that they provide us, because they know best how much it will cost to fix the property, to run it. And if the numbers are different once we take over, they're responsible for that. So they're pretty much validating the numbers, and they have to stand behind those numbers.
Mm-hmm.
So a company that only wants, just to get more properties, they can't get away with it for much longer, because at some point you'll understand that you can't trust them, because the properties that they've suggested were not good and then they're going to lose you as a client. And it's not something that I've personally experienced, but I know that it happened with other syndicators. And so when a property management company tells me this is not a good deal, then I know that this is the right one that I want to work with.
Sure.
It doesn't happen a lot, because we do a lot of research before we send them over. Right. So we know if it's in a crime area, if it's in a good shape, but many times there's information you can only get once you're there.
What are some of the quick resources that you guys lean on as far as like, crime rates, school districts, it could be as simple as like, the right side of the tracks, right? Like one side of one road could be, a good area and the other could be a horrible area. How do you guys quickly determine that, or at least from a high level standpoint? What are some of the go-to resources that you use?
So we use 3 resources. 2 are paid and 1 is free. I'm going to go from the most expensive one to the free one. So the first one is Yardi Matrix, and that shows us everything there is to know about the property, including how much it was bought for, what's the occupancy level, what are, in terms of the, it doesn't show the crime rate, but you can see the average household income, the demographics. And so that's the first piece of information we see. So if I see a property that the average household income is $22,000 a year, I know that it might not be the type of area I want to be in. The second one is Scout, and it's a Scout Neighborhood. It's basically a website that shows you, and it's paid. It shows you basically everything there is to know about the neighborhood, the schools, the crime level, everything there is to know. And then the free resource that we look at is citydata.com, and that shows you, again, household income, crime levels, and how that changed over the years. So when you're looking at all 3 combined, you get a pretty good picture of what type of neighborhood it is. Yardi Matrix actually ranks the areas, the markets, from A to C, from A+ to C-. So the first thing if I see an area that is an A or A+, it usually comes with a higher, 70 to 100, maybe more, $1,000 per household income. And if I see a C or a C-, then it's where it needs more digging, because we know that might be a crime area. We want to make sure, that we're investing in the right market.
No, great points. And yeah, we actually use City Data and we use Scout as well. Yardi Matrix is not really relevant to our industry, but yeah, no, great resources. I appreciate you sharing that. I know that a lot of other folks use CoStar as well. Is CoStar really, is it kind of Yardi or CoStar, one or the other? Are they both provide very similar information, or?
Yeah, pretty much. I would say that Yardi, the thing that Yardi has, and that probably goes back to off-market deals, they provide all the self-managed properties information, including the owner's names and cell phone numbers and addresses. I don't know how they do it, but if this is someone's strategy, then they can use that. Another thing they have that CoStar doesn't is that they have information on every deal on the loan. So when I'm looking at a deal, I know how much it was bought for and what was the loan that was taken. I can see when the maturity date is. So if the loan matures in 6 months, I know that this guy or gal, they have to sell.
They're up against the wall.
Exactly. So that gives you a lot of information, about the motives and exactly where the other, the seller stands.
Yep. Got it. Well, Ellie, I'd love to transition into another segment of the show, which is what I like to call the lightning round. And this is where I'm going to ask you 6 very short, concise questions and look for 6 short, concise answers. So let's get rolling with it. The very first one is your biggest fear. What is it?
My biggest fear is not to grow to where I want to get to. So just stay at a certain level and never grow. And
Okay.
when it comes, can be personally, my personal life and my career, just
Hmm.
stagnation is my biggest fear.
Yeah, that's a good one. How about your one biggest regret?
Honestly, I don't have any. I never look back.
Good.
I never regret on anything. It's part of the way that I operate, basically. And that's a
Nice.
100% true
No,
answer.
that's great. That's mine. That's mine too. In fact, you're the second person here in the last week of my interviews that have given that gave me that answer, which I love. That I think that is the right answer. In fact, if you're living a life with regrets, then you're doing something wrong, right? You got to make some adjustments. So I agree with you there. How about the most influential business book?
The One Thing by Gary Keller, and
Mhm.
also Influence, how to, and also Influence, I forget the name of the author, but two great books that really influenced me.
Okay. How about outside of the daily work grind? What do you do to decompress?
I work out and I love skiing. I love the challenge of skiing. I love the fear of conquering a mountain that looks a bit too,
Yeah.
too steep for me, and then doing it. Just speaking about it, I feel the thrill of just conquering, another challenge. And when you do that, there's nothing, there's no greater, feeling than that.
Do you typically ski in California, or do you head somewhere else in the Midwest? I know you're based in
Everywhere.
California, correct?
Yeah. I'm in California, so
Mhm.
obviously, I ski here, but we actually were starting this the ski season in Canada. We ski all over the place: Canada, Colorado,
Mhm.
Salt Lake City,
Yep.
all across the U.S.
Yeah. No, me too. So I love it. How about the one thing that you can't live without?
The one thing I can't live without, I actually, I'm not sure. I think it might sound funny, but the one thing I can't live without is my notebook that I have, that my to-do list, my goals, challenges, all that. I have to have it with me all the time because it keeps me focused.
Hmm. Good deal. I like that. Going old school though. I love it. I love it. In fact, I
Yeah.
love I love physical. I like writing down physical notes. I mean, I use technology a lot, but even books. Like if I go buy a book on Audible, an audiobook, I go buy the physical version as well. Just to have
Hmm.
love the feel of a book. I never got into the Kindles or anything like that. Just I bought one and I just never used it.
Yeah, same here. But I'm a when it comes to technology, I'm pretty savvy. So the notebook that I have is a reusable one where you can actually
Okay.
write it on it, and then you can, you know, maybe it's not
Got it.
the most technologically advanced notebook, and I know there are a lot of other more sophisticated technologies out there, but that's one thing, also staying green. So it's
Yeah,
I think there's psychologically there's a benefit of writing things down than
absolutely.
typing them on the computer. So
I agree. I agree. How about
yeah.
last one here is what would your backup plan be if one day you woke up and you just decided for whatever reason that you no longer wanted to be a full-time real estate syndicator? What would you do with your free time?
So half of it would be a passive investor, just continue doing what I did today, only allocate more of my money to do that. And on the other half of the day, I would probably be involved in managing or establishing a charity. So I would
Mhm.
feel some sort of fulfillment of doing something that I know will make an impact.
Mhm.
So probably the combination of both.
Okay. Okay. Fantastic. Well, those are all great answers. Again, there's no right or wrong there, but really
Yeah.
appreciate you sharing that with us. I feel like that adds a somewhat of a personal touch to the show here. So much appreciated. And Ellie, what is the best place for those that are listening in to learn more about you and the different projects that you have working right now? What's the best place to find you?
Absolutely. So you can Google Ellie Perlman. You can also go to my website, ellieperlman.com. And this is, if you scroll down, you can see all the various ways to contact me. Just, basically my website.
Okay. Okay. And then the name of your company is Blue Lake Capital, correct?
Yeah, that's correct. Blue Lake
Okay,
Capital.
fantastic. Guys, and I'll also make sure I'll put that in the show notes. The website for her company is Blue Lake and then -capital.com. Blue Lake capital.com. And Ellie, that's all we have today. This has been a lot of fun. I really appreciate you coming back on the show. Again, this was something that we did 6 months ago. We covered a bunch of other topics, but I think that we covered some things today that are very much value add to the listeners. Got a little bit granular on the off market topic and followed a couple other paths as well. I think will add a lot of value to those that are tuning in. So really appreciate you coming back on here. Wishing you all the best success here as we roll into 2020, and also wishing you some fun on the slopes this year. So I know we're entering into ski season. Snow is starting to fall out in the west in certain mountains, and have fun with that. So really appreciate you coming here, guys, and appreciate each and every one of you for tuning in to this week's show. And this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.